As you progress throughout this course, you'll understand why most traders choose the candlestick chart to trade. It has many useful properties that are also easy to use. Each one of these bars that appear in the chart is a candlestick, and we'll talk a lot about them throughout this course. Notice that the x-axis of the chart represents the passage of time, and the y-axis of the chart represents price fluctuation. The next thing you must know about price charts is the time frame. The time frame of your price chart controls how much time it takes for a candlestick to form. For example, if we are in the 1-hour chart of the Euro USD, that means that each candlestick in this chart takes exactly 1 hour to form. When 1 hour passes by, another candlestick begins to form in the chart. As you can see here, there are many time frame options. You can choose from 1 second all the way up to 1 month. In the 1 second time frame, each candlestick will take 1 second to form. In the monthly time frame, each candlestick will take 1 month to form. Notice that you can see the same symbol or instrument in many different time frames. The daily time frame will practically be a different market than the 1-minute time frame, even when we are talking about the same symbol. The time frame you will choose depends on how much time you want to wait for opportunities to align, how fast you can analyze the market in real time, and how much time you have at your disposal in order to trade. In a very fast time frame, like the 1 minute for example, the market develops very quickly, so you must be very skilled. In a slower time frame, like the 4-hour for example, the market develops slowly, so you have a lot of time to think about your analysis and trade decisions. It's important to notice also that the smaller the time frame, the smaller the price movements. So even though a time frame like the 1 minute develops quickly, the size of price movements is small. A time frame like the daily, for example, develops slowly, but the price movements are much greater. The last element of price charts you must know is that beyond price itself, which is formed by the candlesticks, traders will often add other tools to enhance their capacity to analyze the market and detect the repeatable patterns I mentioned previously. There are mainly 2 ways of doing this. We have what are called overlay tools, and we have window oscillators. Overlay tools are any type of technical indicator or line that is plotted on top of price. For example, I can plot technical indicators, which are mathematical formulas applied to price, like moving averages and Bollinger Bands. You do this by opening the Indicators tab and then selecting the technical indicator you want to use. Notice that these indicators are plotted on top of price. That's why they are called overlay tools. There are other types of overlay tools that are not technical indicators. They are different types of lines, like horizontal lines or sloped lines, for example. I can also make use of window oscillators, which are technical indicators that are displayed in a separate window, usually below price. This is the case with indicators like the RSI, the MACD, or the stochastic indicator, for example. You open these in the same way that you open the overlay tools, which is by clicking on the Indicators tab and then selecting the window oscillator of your choice. There is another interesting possibility here that I'm going to briefly show you to spark your curiosity, even though this is not exactly a beginner's thing. You can also use overlay tools on top of window oscillators instead of price. For example, you can draw different types of lines or even apply different types of indicators on top of window oscillators. There are hundreds of possible combinations and techniques here, but that's a subject for another video. For now, I just want you to know that you can apply different tools on top of candlesticks or below them in order to enhance your analysis. In this course, you'll learn a few of the simple ways of doing that effectively. The next step here is to learn more about the fundamental piece of price charts, which is the candlestick. There's a lot of useful information contained in candlesticks, and by understanding how to read this information, you will be able to gain further insight about the market you want to trade. This is the first step in learning how to identify the repeatable patterns of the market. Let's begin with the very basics of candlesticks. Any candlestick is formed by 4 values, also known as 4 prices. These are the open, the high, the low, and the close. Remember that I said that the time frame you choose controls how much time it takes to form a candlestick on the chart. For instance, on the 1-hour time frame, it takes 1 hour for one candlestick to form. The 4 prices will tell a story of what happened with the market within that chosen period. There are mainly two types of candlesticks, the bullish and the bearish candlestick. The bullish candlestick occurs when the closing price is higher than the opening price. The bullish candlestick is usually displayed as a green candle on the chart. The bearish candlestick occurs when the closing price is lower than the opening price. The bearish candlestick is usually displayed as a red candle on the chart. Let's take the example of a bullish candlestick first. Imagine that we are looking at the 1 hour time frame once again. The green box represents 1 hour, and the yellow line represents how price fluctuated within that hour. The opening price is the price at the beginning of the hour. The closing price is the price at the end of the hour. The low is the minimum price that the market reached within the hour, and the high is the maximum price that the market reached within the hour. This is where the four prices come from. The distance between the open and the close is displayed as a thick bar, known as the candle body. In the case of a bullish candlestick, the distance between the open and the low and the distance between the close and the high are displayed as thin lines, also known as candle wicks or candle shadows. The distance between the low and the high is known as range. The bearish candlestick works in the exact same way. The only difference is that the close is lower than the open. The wicks or shadows are formed by the distance between the open and the high and the close and the low. Notice also that this is true for all time frames. Candlesticks can form many different shapes, and each one can have a particular meaning. This leads us to the idea of candlestick patterns, which are patterns of one or more candlesticks that repeat themselves over and over in the market, and they have a particular meaning and a particular name that helps memorizing them. In this video, I will not talk about all the candlestick patterns because there are more than 50 of them. If you want to get deeper into the study of candlestick patterns, I made a video called The Ultimate Beginner's Guide to Candlestick Patterns, which you can check out in the YouTube card. In this video that you are watching right now, I will give you a few examples only because we have other elements and techniques to cover. As I said, I will give you simple and yet powerful examples of candlestick patterns in this video so you can get a feel of how they work. Candlestick patterns are specific candlestick shapes or combinations of specific candlestick shapes that indicate what's going to happen with price. The first thing to know here is that there are candlestick patterns that indicate a future reversal in price and patterns that indicate a future continuation in price movement. The most useful candlestick patterns are the reversal type. These patterns usually have a bullish version and a bearish version. The term bullish indicates upside and the term bearish indicates downside. So for example, when there is a bullish reversal pattern, price will be going down and then a pattern will appear to signal a reversal to the upside. By the same token, in a bearish reversal pattern, price will be going up and then a bearish reversal pattern will appear to signal a reversal to the downside. In a bullish continuation, price will be going up and then a pattern will appear to indicate a continuation to the upside. In a bearish continuation, price will be going down and then a pattern will appear to indicate a continuation to the downside. Let's begin with an example of a reversal candlestick pattern called Harami, which is also known as the inside candle. This is a candlestick pattern formed by two candles. The main thing to look for here is related to the range of one candle in relation to the range of the previous candle. The rule is that the range of the second candle must be completely inside the range of the first candle, hence the name inside candlestick. An inside candle simply means that price has stopped advancing, meaning that it is now stationary. That can indicate a reversal. This is the shape of a bearish Harami or a bearish inside candle. The most recent candlestick will usually be bearish, but there can be exceptions. Take a look at this daily chart of the British pound versus the US dollar. I have marked the range of the last